Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about TLT and the 30-year bond. If you like this kind of content, consider leaving a like, and as usual, nothing in this video is financial advice. So before we even had the Trump tariff announcements, one eerily similar scenario I pointed out on the 30-year bond yield, looking back in history, was what happened from 2005, so really 06, 08 cycle in yields. And I highlighted that there are some differences, mainly in the amplitude and the magnitude of the move. Also, the amount of time that this kind of move is, taken to play out. But overall, the structure is fairly simple. You have a run up from the initial low, a small retrace, a move up, a sideways action, then a kind of blow off top, right? A significant rally, followed by this kind of a W formation. I've read it being called a shark formation or whatever. Fast forward to today, and you have potentially something fairly similar playing out. You have the initial low, move up, a retrace. The first, another significant move up, sideways chop. And again, if you don't recall, this sideways chop came really with the heightened recession fears of 2020, end of 2022, end of 2023, and then bonds having to actually play catch up, which led to the final kind of blow off top, following, which was then followed by this, again, reproposition of this W formation right here. So again, it isn't exactly, spitting image, but again, it is eerily similar to what we saw in the 2006-2008 cycle. The first thing that jumps to mind is, it just seems a little bit more stretched out, and the moves are, quite frankly, more dramatic compared to 06, given the fact that we were just coming off of the zero bound, while in 2006 and 08, we were still at relatively normal yields for a 30-year bond. And we currently are back at, historically speaking, normal yields on the 30-year bond. But nevertheless, right here, we were coming off of, a 30-year bond yielding 1.2% practically. So, in following the comparison to what happened in the 06-08 cycle, I also highlighted how potentially, if we were to follow history, we were most likely right here in August of 07, where we had the second high, which in this case, this is one of the big differences, was a higher high compared to the initial high we saw right here. But nevertheless, we come off the highs, fall below the bull market support band, peek our heads up above the bull market support band, and get rejected and continue downwards. If you fast forward till today, we have the secondary high, we come off the high, we fall below the bull market support band, we peek our heads just above the bull market support band just to get rejected, and we fall back below. Now, honestly, I'm waiting for this kind of correlation to break. I'm waiting for it to deviate, okay? I've been following it for quite a bit. And before I started making videos, whether it was a week ago or so. Because honestly, I don't want to advertise canned tuna and bunker and Armageddon. I don't want anything terrible to happen. Even if it means, potentially, if you're bullish, bonds at least, potentially getting your bags pumped. But I mean, it's coming at great costs. I mean, that's what I'm trying to say. In any case, so far, it is holding. So far, we have the spitting image of what we saw in August of 2007. And potentially, given all the news that we have, we had last night's Trump announcement, Liberation Day, which hurt stocks a lot today, for example. And you could also say that, you did see TLT perform nicely, although perhaps it wasn't as big of a move as one would have expected. Now, I kind of push back against that for the simple reason that this is what you really have to keep in mind if you are in TLT, and so the 20 and 30-year bond. There is a lot to catch up. All right, there's a lot of catch-up play to be played by bonds against stocks. We were historically stuck in this channel, and this is just basically dividing SPY, which is the SPY ETF for the S&P 500, by TLT. And as you can see, ever since its inception, we were stuck in this range when we were bombing around until the pandemic, where we had that incredible monetary stimulus, which propelled risk assets up and bonds really to fall a lot, given the fact that rates had to go up in the face of heightened inflation. Now, this is the reason why I point this out, is because if you're in TLT, TLT is a hedge to this, basically, what you saw today. So you're really having the luxury of something that protects you, of insurance, which also pays you, because it's, the yield right now on TLT is about 3.6%, which isn't life-changing. But while you are waiting for better times, it's good to have. And TLT potentially just have to stay put and don't move, and S&P 500 could continue to move down, and you'd still be up, when priced in SPY. And so that's one thing to keep in mind when you're looking at TLT. Just, I don't want to sound, like an old grumpy grandfather, but really be grateful of what the protection that it is offering, because this is what TLT is really for. This is what bonds are always. This is bonds really fulfilling their duty, protecting you and offering a cushion against negative events. Going back to the 06-08 comparison, if you look, again, right here, we had backtests, got rejected, and then you had further downside action. And we didn't really break the previous low right here until a few months later. What could cause such a break? Well, non-resolution on the tariff front. If these tariffs continue to stick for, say, even a month or two, that could cause some serious damage to the economy, potentially grinding everything to a halt and potentially driving layoffs up, which would would in turn signal a recession, and yields just would have to correct lower. Now, as far as the immediate future is concerned, we have some economic data coming up tomorrow, mainly non-farm payrolls. Now, I want to point one thing out for tomorrow, and that is there is a serious risk that regardless of the data tomorrow, it could be just brushed aside. Given the fact that we are currently in a whole new regime, we are in a world with potentially a tariff war playing out. And given the fact that, yes, non-farm payrolls gives us insight into the state of the labor market, that tells you nothing of what the labor market would look like if, these with these tariffs in place. So I do believe that there is the risk of tomorrow's data just getting sidelined and really not changing things quite that much. Now, I like to give my forecast. I gave my forecast last time. My forecast was for 105K on non-farm payrolls and a slight tick up on the unemployment rate, 4.1. The reason why is because I went over in my previous videos things like the S&P and the ISM PMI reports, and they both pointed towards slowing activity, slowing employment, which again led me to believe that we would have a miss on non-farm payrolls. Yesterday, or rather today, I think we had this came out today really. We had the ISM services PMI print at 50.8, which was a miss. But more importantly, we had misses on new orders and employment. Employment decreased by about 7 points, if I'm not mistaken. Yes, from 54 really to 46. Nothing pretty. And I'm gonna spare you really, going into giving too many details on the ISM report, because mainly it's more of the same of what we've been seeing ever since February. Going back to that theme that perhaps we are moving back to what we saw in the summer of 2024, and that in fact that what we saw in February was not a one-off, and that we have to deal with slowing economy. All right. Same thing for the S&P PMI for services, which again points more of the same really. Yes, growth kind of picked up a bit in March, but the outlook continues to be quite dim. And again, this is something that is a recurring theme in these reports for March. Things kind of looked okay. Well, okay in relation to February at least. But you still have the underlying problems. You still have uncertainty due to tariffs and somewhat fiscal tightening, and the outlook being dim. And honestly, I can't square the two things together. I have absolutely no idea what to expect, because like this report says, jobs growth was also recorded. March saw a welcome rebound in the service sector. And this is something that I've highlighted in the previous reports. So this time I'm not going to give a forecast, because I honestly don't know what to expect. I could easily see non-farm payrolls print something ridiculous like 180 or 200K. But on the other hand, I can also see them being a big miss, given the fact that if your outlook is dim, as these reports are have been pointing at, you're not really going to hire that much, are you? Because if you don't know what the future is and you see new orders not coming in, well, you have no reason to hire. But again, I absolutely have no idea what will happen tomorrow on non-farm payrolls. And again, it could easily be irrelevant, given the fact that we are dealing with a completely new, regime. Really, we're no longer in the old world. We're in the new tariff, and we're living in Trump's world right now. So that could easily lead markets to kind of fade some of the news that comes out tomorrow. As far as the unemployment rate is concerned tomorrow, we had the last piece of the puzzle when, as far as initial jobless claims are concerned, and we actually had a drop to 219, which at the very least to me tells me that I'm not expecting anything too dramatic on the unemployment rate side of things. I could easily see it print at 4.1% and stay stable. What I would say is pay attention again to the labor force participation rate. If you see some kind of movements around the labor force participation rate, that could move the unemployment rate, at least artificially, quote unquote. So I'm not if I had to put my money on one of the two, the non-farm payroll print or the unemployment rate, I would have an easier time betting on the unemployment rate, and I would basically expect it to come in flat. I have absolutely no idea where the non-farm payroll report print will be at. I have absolutely no idea what it could be. As far as answering the original question, what could cause this? Let me see if I can bring it up like this. Let's do this. What could cause a continuation of this, of really tumbling yields? Tariffs just having the effect that most are forecasting, and that honestly I've been talking about. I don't want to pat myself too much on the back, but again, if you watch my videos, I've been talking about the fact that given where we are, inflation, and especially something as bad as potentially a tariff war, a trade war, it's more likely to have a negative effect on growth than on inflation. So this could easily come on the back of just tariffs playing out and putting a headwind on growth, added to fiscal tightening. And I'll address that straight away. The reason why I'm always a bit skeptical when I talk about Doge and fiscal tightening is because it is a gigantic endeavor trying to cut spending. It is extremely difficult. And sure enough, yesterday we had some initial report that Musk would be stepping down in the next weeks from Doge. Now, after a few hours, it was all walked back. Caroline Levitt, if I'm not mistaken, labeled that as fake news. Same thing, Elon Musk directly, just brushed it aside and called it fake news. I wouldn't be surprised if that actually happens in the next weeks. If actually Elon Musk takes a step back and it actually happens, and fiscal tightening shifts from Doge to just something that we've been seeing, and I've been hearing people like Neil Dutta talk about a lot. Just state and local spending remaining sluggish and moving off of the high levels that we saw in the immediate reopening of the economy after the COVID. So I've never been too excited about Doge, not because it isn't a noble thing, or it couldn't have, it's something like that wouldn't have a positive effect, at least on deficit spending, but simply because it's a very hard thing to do. All right, so fiscal tightening remains in motion. I wouldn't be surprised if Elon Musk steps down. It could easily not happen. But again, continue to grab any Doge announcements with a grain of salt. And continue to look at the fact that we've had hiring freezes, for example. That alone is not adding fuel to the fire, so to speak. And again, whenever I talk about fiscal tightening, somewhat fiscal tightening, that's what I mean. I mean, it is second to tariffs, really. Tariffs are really doing the heavy lifting at this point for really disrupting growth. So again, I'm waiting for this to kind of deviate at some point. So far, it hasn't. And we continue to see history play out once again. I'll keep you guys updated. Again, it is a very, very interesting comparison to make. And again, it is very, very, it's eerily similar. It's eerily similar. Overall, I think that this is a process, as I say as I've said in my previous videos, and really will have some kind of a resolution, in my opinion, as we get to the summer. So around July and August, I think that will be the moment of truth. Whether or not we break below, say, 4% on the 30-year yield, and if we do, that would be an indication that we're dealing with some kind of a landing at that point. As far as if you want to look at it, on the inverse, look at TLT. Excuse me. A first initial dark target for the summer, I would say, is 110. Just retesting this trend line that we've got going ever since 2020. If it is just a soft landing, so really a growth scare more than anything else, I wouldn't expect this trend line to break. If, however, it is something worse than a soft landing, anywhere between 120 and 140 is reasonable as an area, and it'll depend on how bad things get. But that is a big if. Again, that's just getting way too ahead of ourselves, I think, at this point. As far as the short term is concerned, in previous videos, if you recall, I spoke about the possibility of retesting this trend line. And honestly, last week we had quite a few reasons to potentially retest that trend line. We had PCE, the possibility of PCE printing in quite hot. That didn't happen. And overall, the negative things to growth have continued to play out, mainly tariffs with yesterday's announcement. So I would be tempted to say that this is off the table for now. A retest is off the table, given the fact that we are now dealing with lower growth expectations at this point. And if indeed we have retaliation, that could give TLT extra room. And as non-farm payrolls are concerned tomorrow, if you see a very negative number, say something like 40 to 60K, that could definitely propel TLT higher, just adding fuel to the fire. Because at that point, I could easily see the like the narrative being we have a cooling labor market, and on top of that we're having tariffs. So it's kind of like a double whammy tomorrow. But I really don't know what non-farm payrolls is going to do tomorrow. As long as this is a status quo, expect more of the same. As I say in my previous videos, as long as we have tariffs and somewhat fiscal tightening, and as well the yen carry trade ad, but really being the cherry on top of the cake, expect more of the same with some short-term fluctuation. But again, you know me by this point, I'm not really too bothered about short-term fluctuations. I'm interested in the direction really of the asset at hand. Overall, what we've seen in the last few days increases the chances of this secondary high-low being the definitive secondary high-low, well, the secondary low. Because again, just going back in history, for people that haven't followed my videos, TLT likes to put in double bottoms, and it's either a lower low, like we saw in 2007 and 2008, or it's a higher low, like we saw in 2010 and 2011. So far, it seems to be playing out like the 2011 double bottom, where you have a slightly higher low on TLT. And before I close off, that really is, if you really wanted to poke holes in the comparison, that would be a great place to start, honestly, because this time around, the first high, which would be the first low on TLT, the first high on yields, was the high point this cycle. In 2006, 2008, excuse me, the second high was the high. Second, if you notice, the kind of low points of the W are inverted. The first dip was deeper than the second dip. Right here, the second dip was deeper than the first dip. And again, coming back to the original point, the fact that we had a second high on yields basically just points to the fact that this time around on TLT, we have a higher low as opposed to what we saw back then. A lower low, kind of sweeping the previous low. So there are some differences between the two, but overall, if you wanted to paint a, say, look back in history and see if something similar occurred, the 2006-2008 cycle is really the most similar occurrence in history. So really, that's pretty much it. As far as the immediate future is concerned and price action is concerned, non-farm payrolls will definitely move things if it is extremely negative. If it is more or less around expectations, which would be Tuesday, Thursday, Friday, right here. Consensus is for 128. If you see something like 100K or 140K, 150K, I don't think that would move things that much. And it would just reinforce the fact that, yeah, we have this print, but everything just got flipped on its head. All right. So, but overall, I have absolutely no idea what, farm parallel print will do. I just know that, I just think, that's me being too dramatic, that if we get something below 100K, that could add fuel to the fire. Absolutely. Consensus for unemployment rate is 4.2. I would look more at just staying still at 4.1. Definitely if, the unemployment rate moves up, that could give reason to, again, just adding fuel to the fire. The reason why, again, as I said in the previous part of the video, I don't expect the unemployment rate to move that much, simply because initial jobless claims have been quite benign this month. I do expect them, as I said in my previous videos, to move up, for them to move up as we move towards the summer. But as far as March is concerned, we didn't really see anything too aggressive. So I wouldn't be surprised if we have 4.1 on the unemployment rate, barring any surprises on labor force participation rate fluctuations. So that is pretty much it. I'll leave it at that. I'll keep on making videos on the 0608 comparison and see how things evolve. Hopefully we don't have to buy any canned tuna and canned corn and hide in a bunker. But hopefully I did a good job at showing you where I stand. I'm still pretty tired. So I know these videos aren't the best they could be. But in any case, this is it. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.